I'm the chairman of the committee, Roger Horton, and with me today is Eileen Schneider. Ms. Falcone is usually with us, but she is under the weather today, and so it'll just be the two of us for the committee. We have a number of reports to review, and I'm going to ask Mr. Pearson to start us out.
Thank you, Mr. Chair. Good afternoon, committee members. Bob Pearson, Finance Director, and we have 5 items actually on the agenda today, but 4 of them are interim financial statements. We have 2 months worth of interim financial statements for the redevelopment agency and 2 months for the city, and those 2 months for each of them are January and February. And with your concurrence, I would recommend that we focus on the February, the more recent of the 2. I don't know that there's much sense in looking back at the January ones.
It seems fine, Bob.
So with your permission, we'll start with what is item number 11 in the council agenda packet, which is and I'm sorry, Mr. Chair, I swapped it on you, but the redevelopment agency interim financial statements for February. As you know, for both the redevelopment agency and the city, this is not a quarter-end month. February obviously isn't, so we don't have a formal presentation. We'll say that March, of course, will be a quarter end, and that will be our 9-month review, at which time we'll be prepared to give you a more complete update on where we stand after 9 months of the fiscal year and what it's looking like in terms of achieving the expenditure control targets that we have set for ourselves this fiscal year in order to try to avoid the use of our completed budgetary reserves. So I would expect that report would be coming to you within the next 4 or 5 weeks. So with that, the interim financial statements for the redevelopment agency for the 8 months ended February 28th, as I said, item number 11.
So happens I have a couple of questions. Hopefully these won't be too difficult. I'm looking at the RDA General Fund report, Brian, page 1. I was looking at the loan interest, which is at 575%. Is that a function of the loan being ahead of schedule, or what? Can you tell me what's going on with that? If not, you can
Councilmember Horton,
later.
The interest for that particular loan is, we refer to it as the Borderi loan, and it has to do with parking structure number 10, or it's adjacent to parking structure number 10. I do not have an answer for your question. I can look into that, and I'd be happy to get back to you.
Offline is fine. And then on page 2, the housing fund, similar question on the under revenues, the third item down, interest loans. There must be something going on here. This is showing at 219% at 8 months of the year, so there's something peculiar there. There's way more interest showing than there is budgeted. So if you don't know, then you can just get back to me.
This one, ironically, I do know.
Okay.
And that comes from payment from Cottage Gardens. It was from interest accrued from 1992 to 2008. So that's why you see that big lump sum increase.
Okay, great. Ms. Schneider.
Question on, we're hearing information about working with the downtown organization in the next several months on storefront gallery work and the RDA funding that. Where does that fit in this budget?
That is a good question. What we're planning on doing, or what we are doing right now, we'll be before the agency board next week on the 21st with an update of that particular program, and have hopefully developed a more appropriate or eye-catching name for it. But we'll be before your board next week, and we are working with the downtown organization as well as the County Arts Commission to implement a storefront program which will utilize the expertise of the arts folks at the Arts Commission as well as the knowledge of the downtown organization. That has been entered into through a purchase order agreement, and so we are currently processing that and on the initial stages of that moving forward. It's not so much a capital project as it is kind of a
So where would we see it in here? Because if it's something that's going to go through the summer and into the fall, it'll go into next year's budget as well. But if I was looking for it in this kind of budget document, where would it go?
being that it's a purchase order, I don't think it has a particular project number, fund number. But what we could do is maybe we could put an attachment to this that because we do have a number of miscellaneous
Right.
things that we do that do not necessarily fit under these particular
Because it
funds.
kind of fits under economic development, community relations, especially dealing with businesses downtown. It might be nice to capture that so that people can see what the redevelopment agency is doing in terms of trying to boost local economy, and especially in the redevelopment agency zone. And I don't know if that's for next year's budget and how we allocate that, but I think people might ask about what's the city doing to be business friendly and help them in these economic times. And this is a great example, but if there's nowhere where you can see it, you don't know how to quantify that. So.
I couldn't agree more. I think that's a great idea. And another one that might fit along similar categories, not necessarily under economic development, is the Children's Museum and all our work that we're doing with that particular project. And that doesn't show up in here as well. So maybe we can add something in there that points to all those other tasks that we're assigned with that are definitely benefiting the community and the project area as a whole.
Great, thanks. Those are my questions.
Okay, Brian, I just have, I think, one more question. On page 5, which deals with the Series 2003A bonds, I think most of this I understand, but looking at number 7911, the Mission Creek Flood Channel, it seemed like that project is moving along, and yet it doesn't reflect here.
Councilmember Horton, you're correct. This particular project, when it was set up, when the bond was issued back in 2003, there was, I believe, $2.5 million in that project fund. It was geared towards aesthetic improvements to the Army Corps / county / city project of Mission Creek Flood Control. So what we were doing was waiting for appropriate opportunities, whether it would be the purchase of land for pocket parks or other aesthetic amenities to add to the design in a downtown area. Since that time, what we've done is with your okays, we've purchased 2 properties on the corner of Bath and Ortega at about $1.1 million. And also back in December of 2008, when we moved forward with our capital program, and funds were moved around, and a good portion of that and some additional money, a total of $2.5 million, was put towards the Mission Creek Flood Control Project at the train depot to get that next phase put in. What was left here was about $750,000, which this money, the 7911, will be geared towards an eventual some sort of park, either a children's park or a pocket park at those properties on the corner of Bath and Ortega that we purchased last year. So we're waiting for an adjacent bridge project to move forward, and then we'll.
So that's legitimate. As long as we're taking a look at this, the planning phase set of programs there, some of these are not necessarily going to move ahead, and some are. Are there any changes on this list here going on down 8959, 8975 that you could comment on at this time? I mean, not a lot is happening on that block.
Let's see. Under the planning phase, the Creo Chapala Transit Village, we are still working with MTD on that particular.
Totally understand that one.
The waterfront property development is the agency's property at 125 Calle Cesar Chavez.
I know where that one is.
Mission Beach Flood Control, that again goes. We've changed the name on that. That's the train depot portion that I just mentioned, the Mission Creek Flood Control Project at the train depot.
Okay.
The Helena parking lot, we're preparing to issue a request for proposals for design and engineering services. That's the agency's property on Helena Street next to Mr. Parker's youth hostel that will be eventually developed into a parking lot. And the Chase Palm Park Wisteria Arbor, we're working with Parks and our planning staff, as well as Mr. Parker and his team, addressing the transition zone between the eventual hotel and the current park that we have. Okay,
good. Maybe at some future meeting I wouldn't mind having a kind of a complete rundown by you guys on all that. Okay, Mr. Pearson, did you want a motion on that, or? Would you
I'll
care to?
move
Yes, sir.
items number 10 and 11 to council.
I will second that. Is there any further comment? If not, all those in favor say aye.
Aye.
Motion carries. Mr. Pearson.
Thank you, Mr. Chair. Then we would like to move along then to item number 6, which is the city interim financial statements for the 8 months ended February 28th. And the same thing, of course, applies to the general comments I made up front about this not being a quarter end, and that the next big one will be the March quarter end, the 9-month review.
Ms. Snyder, any questions? I have a couple if you don't.
I guess, we'll get a better idea at the quarterly statement, just looking at the revenue and expenses on the non-general fund ones. I know the golf course we've always been monitoring, but the others, in terms of downtown parking, it looks like there's a big gap there, 61.3% in revenue with 67.6%, which actually is almost a percentage higher than the budget year. So, is that one in particular? Are we waiting for something to happen in the last quarter, or?
Councilmember Schneider. Actually, speaking with the downtown parking folks, the revenues are coming in under what they had budgeted, and
Okay.
we anticipate that. This also includes a lot of encumbrances that for that 67.6%. That includes encumbrances, long-term projects. We're in the process right now of setting up a separate capital fund for that. That is
Okay.
almost completed, and I think we're going to find these anomalies not being so much and kind of going away the next time we meet.
Okay, and then in the airport operating fund, it looks like revenue's higher, but yet we're hearing passenger count is down. So, can you comment on that, or?
Excuse me.
Actually, Hazel's right here too for another item. But
Actually, some of the, if I'm not mistaken, and I've been focusing on a couple of other things here, but one of the big things that's driving this is the leases, the commercial leases that they have out there in the airport. Yeah, the terminal passenger counts are down, but we're having some positive results in some other areas.
so it's balancing it out. Okay. Just, we're talking about the general fund mostly, which we should be, but yet we still want to keep an eye on all the others. So
Yes.
those are my questions. Thank you.
Okay, Rudy, a couple of quickies here. On page 9, Water Operating Fund, the catered JPA treatment, we've collected more revenue than we budgeted. Do you know why that would be?
Yeah, Mr. Horton. The reason for that is that we have this JPA agreement with Montecito and Carpinteria Water, and so they reimburse their share of the operating costs. And so when the operating costs are a little bit higher than what was originally budgeted, their reimbursement actually comes in higher. So that's why we have that positive variance on
Okay.
those revenues.
Would that apply as well to page 10? Special projects under wastewater operating fund, where we've spent about $250,000 more than budgeted, or is that a different issue there?
Actually, I believe that's a different issue. If I'm remembering the numbers that go into here, this has to do with the sewer lateral rebate program,
Makes sense.
which we had an item go to council recently to move some money over for that. And so this should also even out this next time you see this report.
Okay, great. I think that's about, I know. I just got one more question. Almost there. Page 16, the self-insurance fund. Notice that the year-to-date actual at 354. Is that an experience item there, reading under miscellaneous?
Oh, yeah, it was. Yeah, Councilmember Horton. This actually is a result of a litigation settlement that we received, and so that's what threw that number out of whack. It's nice to get that money back.
That's
in.
just fine.
Yeah.
Glad to hear it. Great. Is there a motion?
I'll move items 5 and 6 to council.
I will second. All in favor, say aye.
Aye.
Motion carries. Mr. Pearson.
Thank you, Mr. Chair. We will move on then to the final item on today's agenda, which is item number 17, which is a report On the airport terminal project, specifically the joint use rental car facility, and as you know, the committee knows, we've had this item in front of the committee and in fact the full council a number of times now. This item, with your concurrence, of course, is on the full council agenda later this afternoon. As you know, just by way of background, and I know you're aware of this, but I think it's probably helpful to restate some of the background. Part of the airport terminal project was the replacement of the current rental car facility, which is just south of the current terminal building. And that rental car facility needed to be demolished in order to make way for the terminal project. So that had to be done in advance, even though it was really part of the project. And because of the timing on the financing of the project, as you know, we have yet to sell the bonds for the terminal project, although as an aside, we do expect to sell those bonds within the next 2 weeks. So that's, I think, good news. But we actually, in order to get this piece of the project going, the council approved back in July of 2008 the issuance of an airport promissory note for $7.8 million, which we then, the council authorized me to purchase into the city's investment portfolio. And we have done that, and then we extended that, council did, authorized the extension of that promissory note, the maturity date of it, through June 30 of this year. And that's where we stand now. The intention had always been that we would repay that promissory note from the proceeds of the airport bond that, as I mentioned, we will be issuing within the next 2 weeks. Now, this would be a separate piece of that bond issue because, unlike the terminal project piece, this is a taxable portion of the bond, would be a taxable piece of the bond issue because the proceeds are being used specifically to support private sector profit-making businesses. And so the initial concept was the bond issue would have two segments to it, if you will. The primary and much larger segment would be tax exempt, and that would be for the public infrastructure improvements, including the parking and the terminal and the like. And then a much smaller piece, which would be taxable for this joint use rental car facility. In talking to our bond team, including our underwriters from Morgan Stanley and our financial advisor from Kelly North Cross Nobrega, it became apparent to us that marketing this piece, or including this piece of it in our bond issue, could, and I stress could, because you wouldn't know until you actually try it, but could adversely affect the marketability of our overall bond issue, simply because, as we know, the bond market has been unsettled, to say the least, for the last 6 to 9 months. And while the standard tax-exempt municipal bond market has recovered nicely, to the point where, as we've told you before, we expect that when we do sell the bonds in the next couple of weeks, the tax-exempt piece will be somewhere between 5.5% and 6%. Apparently the appetite for municipal taxable debt has not recovered as nicely. And so there was a concern that perhaps this sort of the tail wagging the dog, the small piece of the bond deal, could actually adverse the overall marketability of our main piece. And so that caused us to go back and look at it. And as you know, we've now financed this through an airport promissory note now for almost a year, 9 months really. And it caused us to go back and think, well, why wouldn't we consider then breaking this piece out and financing it with city funds for the long term? And so that's what we began to consider, and we ran it by our underwriter and financial advisor, and they all thought that if that was something we were willing to do, that it made a lot of sense from the marketability of our tax-exempt larger piece for the terminal. And once we'd gotten to that point, we looked at it more closely, and we felt that this was an opportunity for both the city and the airport to arrive at a mutually beneficial solution, which would be that the city would finance this by the issuance, instead of a short-term airport promissory note, by issuing a long-term airport promissory note, specifically 20 years. And you see that in the agenda report, as an attachment, we gave you an amortization schedule of that. There are a number of factors that are worth noting. One of the reasons we feel comfortable recommending this to you is, as I think you will recall, the joint use rental car facility, ultimately, the cost of that is being paid for by what's called a customer facility charge, or a CFC. It is a $10 per rental car contract surcharge that has been in place since January of 2006. We've been collecting money on that. Some of the money has gone into the project. It was used for the design work. And in the meantime now, the rest of the money, since the loan was made from the city airport promissory note issuance, we've collected and accrued additional CFC revenue to the point where we're now projecting that by the end of this fiscal year, we might have as much as $1.2 or $1.3 million of CFC accumulated money in the fund. The good news, and the reason that this has an impact on our recommendation to you, is that really this facility and the financing of it has a dedicated source of repayment. We've set the CFCs, as we're required to, up in a separate fund within the airport department, so it's accounted for separately. We can track it separately. We've done what we believe to be fairly realistic projections of CFC revenue out over the next 20 years, and we believe that on a 20-year amortization that the CFC fund can afford the debt service that is proposed in the amortization schedule. So that seems to all work. I mentioned in the agenda report that our underwriter told us last week that as of that particular point in time, if we were to look to sell this piece on the market, that the market interest rate for this taxable piece would be approximately 8.5%. As you know, we're recommending an interest rate of 6.5%. That's 200 basis points, or 2% lower than what we had been told to expect for a market rate. Clearly, that's going to save the airport money. We think that it's also an extremely beneficial rate for the city investment portfolio, because the investments, treasury bills, federal agency securities that we are currently acquiring in the marketplace for our investment portfolio are in the neighborhood of 2% or even less, some of them 1.5% and 1.25%. Now, it's important to point out that those investments are for 2- and 3-year period of time, not 20. But just to give you a benchmark, the underwriter told us that the airport bond deal, this piece of it, would sell on the market for at a rate that was 500 basis points, 5%, above the 30-year Treasury rate. So we're now looking at a 20-year term, less than the 30-year term on the Treasury. So it is important, though, to point out that you just can't 0.6% compared to 1.5% for what we're buying because of the term difference. But the good news is that it will triple the average rate of return that we're currently earning on investments we're purchasing for the city's portfolio. And so that will generate a substantial amount of investment income for the portfolio, which will be shared by all the city's funds, including the general fund. And certainly in these difficult budget times, that kind of pickup in yield is something that would be welcome. So I think it's a combination of three things. One, it's an opportunity to save the airport some money, including the transaction costs that will be avoided. It's a way to pick up a substantial additional yield in the city's investment portfolio, while doing so with what we believe to be a very secure investment. And it will break it out from our total package of financing for the terminal, thus not risking affecting our marketability of the main piece of the bond deal with this much smaller piece. So we're recommending a 6.5% interest rate, a 20-year term. And as I said, the amortization schedule is attached. It would result in annual debt service payments for the CFC fund of about $657,000. That concludes my report. Of course, I'd be glad to answer any questions I can.
Well, actually, I have a suggestion for you, Mr. Pearson. Being one who is actively interested in doing whatever we can for revenue, I'm wondering why we don't move that percentage up to 7 or 7.5, since according to your paragraph here, 8.5 is what the market rate would be. I'm not sure why I see going as low as 6.5. And if it's as secure as we seem to think it is, it seems like the benefit would accrue to the city, which definitely needs it. And so would you like to explain that for me?
I would, Mr. Chair, actually. But if, with your permission, there is one thing I forgot to mention, and that is that the original note that is currently still outstanding, the interim note, is in the amount of $7.8 million. The long-term note that we are recommending is $7.3 million, $500,000 less. The reason for that is that, as I mentioned earlier, there will be an accumulated amount of CFC revenue in the fund at June 30 of about $1.2 million, in that neighborhood. And we feel that we can afford to take $500,000 of that and apply it to reduce the principal balance of the promissory note. The question was asked to me before, why only $500,000? And the answer to that question is because the airport still has yet, the CFC fund still has yet to pay the interest on the original outstanding note. That'll be about $500,000. So if you take the $500,000 pay down, add in $500,000 for interest expense on this first year of this promissory note, that's $1 million. That would leave somewhere between $200,000 and $300,000 in the fund, which we believe is a prudent thing to do to help cushion in case the CFC revenues don't meet expectations. Then there will be a cushion there which will help us, at least in the short term, to continue to make the debt service payments in full. Now, to your question, sir, I'm going to... This is a schedule which I've run, which shows what the annual debt service payments would be on the note at quarter-point intervals, starting at the 6.5% that we're recommending and going up to the 8.5% that is essentially the market rate. And what you will see is that for every quarter-point increase in the interest rate, the annual debt service increase is about $13,000. So, more or less. So, when we were looking at this, essentially, we thought that, we would sort of split the difference between what the market rate was and what our sort of investments are earning now. The other thing is, if you look at the bottom of the schedule, you will see that for fiscal year 2010, that our estimate, our projection of the CFC revenue is $634,000. We're actually expecting that this fiscal year, the CFC revenue will be down 8%. As a result of the decline in passenger counts. And then for 2010, we are essentially predicting no growth. So I think we're being fairly conservative there, but you can see that the recommended 6.5% interest rate is very close to the annual debt service amount. But as you raise the interest rate, you raise the gap between the projection for the CFC revenue and the annual debt service amount. Now, it's clear that as we go out further in time, we're projecting CFC revenues to grow about 2% a year after we get by the next couple years. And that would mean that within a couple years, the airport, the CFC fund could certainly afford a higher rate of interest. But I think at this point, there was no magic to the number. It was a selected number that seemed to sort of split the difference between sharing some of the benefit between the airport CFC fund and the city's investment portfolio. But again, no magic.
Well, I don't see any reason why we shouldn't at least move it to 7. I'm not seriously proposing that we move it to 8.5, but I'd like to see 7 or 7.25. Unless there's... Let's find out what Ms. Schneider says.
Well, let me start by just asking some questions. You used the phrase financing with city funds, and I just want to be clear to anyone listening that the city funds, this is part of our investment portfolio. This is money that would be invested one way or another. It's not general fund operating. It's, just to clarify that piece of it. But I guess the layer to the question is, because this is a 20-year term, the funds are sort of tied up for a long time, as opposed to our what we've seen in investment policy reports, where you only there's a few years before something's callable or before you put back out to market. So could you just comment on that a little bit in terms of security of the funds of using city funds to finance an airport project and the
Yes.
security behind that?
Yeah, Mr. Chair, Councilmember Schneider, that's right. I mean, this is not a loan from one fund to the other. I mean, we have done that in the past. We have a couple general fund, interfund loans out right now to the waterfront fund. But this is not the same as that. This is, as you correctly point out, this is purchasing an investment, which the council would need to authorize us to do, purchasing an investment in lieu of some other investment we would purchase, like a treasury bill or an agency, federal agency security. And again, I think the security lies in the fact that this is a state-authorized surcharge. The CFC, state law, permits these. We've had one in place since 2006. We have a strong history of collecting this money now for a couple years. The money continues to be collected. And it is a dedicated source of repayment. It cannot be used for anything other than paying for this joint use rental car facility or paying the financing costs of that facility. So it is a restricted revenue source that can only be used for this one facility, and it is a surcharge, a fee that we've had in place and that we've levied pursuant to state law. So I think that with that dedicated source of repayment that we have, legally restricted to be used for this project or to pay the financing costs, then I think we feel comfortable doing that.
And then tying up this money for 20 years versus
Yeah,
5 or...
Yeah, I think that's would normally be of some concern, but I think in this case, given the fact that all of our other investments are at 5 years or less, and we have a fairly carefully laddered investment portfolio, meaning that we have investments that are going to mature next year, and then we have another chunk that will mature the year after that. From a cash flow perspective, this will not be an issue. I mean, it simply won't be an issue from a
Right.
cash flow perspective.
And then the airport, if they were to sell the bonds in the private market, all this interest would go to them, not to
That's correct.
back to the city. So
Right.
that's and at a higher rate.
Right.
You mentioned 8.5% being the current market rate. If we were not in these weird economic times, maybe if this was 5 years ago or something like that, what would be a typical rate?
I think if typical for a taxable municipal of a 20-year term, we would probably be looking at something like 7 or 7.25.
Okay, so that's where Mr.
I need
Horton's...
to mention one other thing, and that is that, excuse me, that one of the things I did not mention is, and it's only moderately important, and I'm being facetious, is that the question could arise, are we authorized to buy this as an investment? And it's important to point out, I think, that both the state public investing code and our city investment policy do permit us to purchase city instruments, either issued by other municipalities within the state or our own. State law does impose a limit of 5-year term on investments that public agencies purchase under normal circumstances. We cannot purchase an investment that has a remaining term to maturity of more than 5 years unless the city council so authorizes us to do so at least 3 months in advance of the purchase.
Okay.
And so what we're recommending to you in this agenda report is that the long-term note be dated 3 months from today, which would be July 14th, and that you extend the short-term note from its current June 30 maturity date to July 13th to make the transition between the short-term note and the long-term note seamless.
Right.
And so if council so approves, then, and I've quoted the sections of the state investing code in the agenda report, then council does have the authority under state law to authorize the investment of a term exceeding 5 years.
Okay. And if for some reason the airport people start renting cars left and right and their revenue goes well above what they're projected? Can they pay down the principal early? Is there a pre-penalty payment or anything like? I mean,
Yes, we have a, no, they can,
I mean,
No,
these are
no, it's
things
a
you
good
ask,
question.
right?
No, it's a
If
good
they wanted
question.
to pay off earlier than the 20 years, can they do so?
It is a good question, and yes, to the extent that the collections exceed expectations or projections, then those funds will be applied to the note.
Do they have to be applied that way, or can they use it as part of operations for the year? So they have to go right back into
Yeah,
paying
they
off
can
the...
only be used, as I said,
Okay.
to pay for the cost of this facility. Now, the other thing is, well, let's flip that on its ear and say, well, what happens if collections
Are
fall
under.
short of
Right.
our projections? The good news there is if you look at the amortization schedule, at a minimum, we believe that the airport CFC fund would at least be able to make interest payments, and therefore, even in a sort of a bad case scenario where they couldn't make the full annual payments, they would at least be able to make the interest payments in the early years, as you'll see. You say, for instance, year one, at least at the 6.5% interest rate, interest constitutes about $470,000 and principal $186. So I think we have that cushion, and yes, that would probably extend the maturity schedule, but maybe not, because it could be made up later if collections start to rebound more quickly. So I think that, from a security standpoint, even if collections don't meet expectations in the first year or two,
okay.
I think we've got enough wiggle room there.
Okay. That helps. I guess that helps actually in terms of looking at the percentages. I guess my thought is, and I want to hear the rest of the council since this is coming up today, is I can see going to 6 3/4. I mean, it's significantly higher than what we're currently getting in our investments, but I don't want to overstep and feel greedy about it, even though, the option's certainly there concerning what savings the airport might receive by going through this route as opposed to going out to the private market. So I could see wiggling up a little bit. I wouldn't want to go up as high as 7.25 or 7.5, but I could go up a little bit if that we think might assist city finances and still provide a good savings and a good deal for the airport.
The reason I mentioned this today is that I'm involved in a couple of nonprofits that are holding notes that were issued at a time where things were different, and in looking back on it, it looks like they weren't anticipating that anything would ever change. And I'm hopeful that the general economy is going to pick up by the time we get to 2028. And so I felt pretty confident in saying the 7% was a reasonable number if we look back in time. And so I don't know whether we want to talk about that this afternoon later or however.
We certainly can, and it's, of course, the prerogative of the committee to make a recommendation to the full council. I will point out that the structure of the note that we are recommending to you would set the initial interest rate, the recommendation at least, is 6.5.
Right.
But it does say 6.5% or the LAIF rate, the local agency investment fund rate, whichever is greater, up to a cap of 9%. So we do have some protection if the economy rebounds and as a result of all of the money that has been put into circulation, interest rates and inflation accelerate. We do have a protection for the city's investment portfolio up to a cap of 9%.
Ms. Johns is here. Would you like to say anything, or have you what you heard? Are you okay with everything you've heard?
Certainly, I think we're okay with everything. You need to go to the mic.
Hazel Johns, Assistant Airport Director, Council Member Horton and Snyder. The interest rate at 7%, I think, is doable. I think if we get higher than that in the next 5 or 6 years, I think it would be difficult for the airport unless we did just pay interest, just because of the slowdown in the airline traffic and passenger traffic.
Okay, thank you. Would you like to make a motion?
Sure, I'll make a motion to council that we move this item to council with the Finance Committee recommendation of 7%.
I'll second that. Any further discussion from anyone? If not, all those in favor say aye.
Aye.
Motion carries. Now, Mr. Pearson,
Mr. Chair, that concludes
do you need
our
further action on this, or
agenda.
does that take care of it?
That takes care of it.
All righty. Well, thank you, and that concludes our meeting for today.